What if the way we track corporate performance is holding back long-term success? That's the provocative question U.S. President Donald Trump recently raised, sparking a fresh debate about how companies disclose their financial health. In a bold move, Trump suggested shifting from quarterly earnings reports to semi-annual filings, a proposal he claims could save money and let executives focus on properly running their companies. But here's where it gets controversial. Is this a step towards smarter business practices or a risky gamble with investor trust? Let's break it down. Trump's idea, shared on his Truth Social platform, leans into a familiar critique. The U.S. fixates on quarterly results, while nations like China take a 50 to 100-year view. But is that really how things work? Chinese companies, in fact, face quarterly reporting mandates just like American firms, though Hong Kong-listed companies are an exception, opting for 6-monthly updates. The UK and EU already require semi-annual filings, showing Trump's proposal isn't entirely novel. Still, the debate it ignites is far from settled. This isn't the first time critics have challenged quarterly reporting. Back in 2018, Warren Buffett and Jamie Dimon argued in the Wall Street Journal that short-term earnings guidance harms long-term growth. They warned it creates a toxic focus on immediate profits over innovation and sustainability. Yet supporters of the current system argue that quarterly reports give investors timely, transparent insights into company performance. So who's right? And should the SEC or Congress even get involved in reshaping this system? The rules aren't set in stone. While the SEC currently enforces quarterly reporting, forecasts are voluntary. Changing this framework would require regulatory or legislative action. Meanwhile, Norway's sovereign wealth fund recently floated a similar idea, claiming longer reporting cycles could foster better strategic thinking. But what about the risks? If companies hide behind 6-month gaps, how will investors detect problems early enough? And this is the part most people miss. The global landscape is already shifting. While Trump's plan mirrors practices in Europe, it contrasts sharply with Hong Kong's semi-annual model. Yet China's strict reporting rules and the U.S.'s own regulatory history show there's no one-size-fits-all solution. The real question is whether the benefits of long-term focus outweigh the costs of reduced transparency. So where do you stand? Do you think quarterly reports are a necessary evil for investor confidence? Or do they force companies to play a dangerous game of short-term gains? Share your thoughts in the comments. We're curious to hear if you agree with Trump's vision or think it's a step too far. After all, the future of corporate accountability might just hinge on this debate.